go, here we go, here we go, here we go. It is Fed Day. Let's go. Hey, what's going on, everybody? This is the blockchain backer, bringing you the latest cryptocurrency news and analysis. Welcome to Fed Day. I'm used to saying this is markets in the morning, but it's not. This is Fed Day. We are live streaming the Federal Reserve's interest rate decision that we are about to have here in 4 minutes. If you are watching the replay of this, you can skip ahead 4 minutes from right now to see how the market reacts once the decision comes out. If you are watching the replay right now, you can skip ahead 34 minutes to when Jerome Powell will be coming up to speak. Otherwise, the rest of us who are actually watching this thing live right now, we are going to have to wait the 4 minutes. We're going to have to wait the 34 minutes for Jerome Powell to come out and speak on the Federal Reserve's forward guidance. So right now, the market does have it priced in at a 95.9% probability that the Fed is going to be paused when this comes out. So we'll sit here refreshing the Federal Reserve's website. And the question is, has the market correctly priced in the probabilities of rate cuts moving forward? And so that's what we're going to be looking for. And, you know, when this kind of explain to you how this all goes, essentially you could see there on the bottom left side of the screen over here, right here, this box that we've got going on right here. This is where the live stream of the presser will take place at. Whenever he does go live, I will make this bigger and then I will shut my yapper and I will not say a word during the entire press conference as it goes on with Jerome Powell. So I also don't provide any analysis of the reactions of the market during these times right now. These are typically volatile moments. We typically, whatever direction we end up going in the beginning could be completely different from what happens in the end. And then whatever happens in the end could be completely different than what happens tomorrow. So really, it's just kind of a watch and see and buckle up, get some popcorn made, put this up on your television and sit back and relax and put a diaper on and see how it goes, because it can sometimes be pretty wild and pretty crazy. So, all right, here's where we're at right now. We are 2 minutes away from the decision happening here. And so what I've got right here is I've got Bitcoin here on the top. I've got the Dow Jones down here on the bottom. And as you can see, I've already pre-marked for us just so I didn't have like fibs all over the screen and a bunch of stuff. I went ahead and just put exactly where the 4.236 extension is based on the great financial crisis, right there at about 39,200. It's about 1.88% away from where we are right now. And that's what we've got marked there. So as for gold and as for the United States dollar currency index, I also have these going. And then I've gone ahead and kind of pre-planned. I got the stocks and everything and precious metals on the dollar over here on the right side of this screen. And then over here on the right side of the screen, we have crypto over here. So as we get ready to start, XRP is back in the green for those who have been paying attention to that. We'll cover that stuff later. Right now, we are in the thick of a moment about to happen here in 1 minute and 20 seconds. So as we get started, okay, total to the altcoin market is down about 0.25% in general. So 1/4 to 0.5% is about what we're down. Bitcoin's up about 1.25% before we get started. The indexes, the Dow Jones is up 17 points, while the NASDAQ is down almost 200 points. The S&P is down 35 points. So the Dow is practically flat. The S&P is down 0.75%. The NASDAQ is down over 1%. Before we get ready for this thing to kick off in 40 seconds from right now. So here we go. It's expected to be a pause. The question will be, what will the wording be like? And we'll bounce back and forth to see what the wording was on the last one, the one that got everybody all hopeful and all this stuff in here that there's going to be rate cuts, and to see if there's any differences between then and now. So what you'll see here is as I'm going through this, so typically when I'm live streaming, I do a pretty good job of just kind of continuing to talk and keep the silence at a minimum. When I bounce around in here, I sometimes am a little silent. It's just me just trying to refresh and get through everything. So here we go. 3, 2, 1, let's go. Just pounding F5. There it is. Maintain the target range. Okay, it's maintaining. Recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have moderated since early last year, but remain strong, and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. The committee judges that the risks to achieving this employment and inflation goals are moving into better balance. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. In support of its goals, the committee decided to maintain the target range for the federal funds rate of 5.25% to 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the involving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it's gained greater confidence that inflation is moving substantially towards 2%. In addition, the committee will continue reducing its treasury holdings. Whoa, do you see what they just did there? That's new. Okay. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in its previous announced plans. The committee is strongly committed to returning inflation to 2% objective. I think this is all just your standard stuff in here. Let's go back through that. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the involving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving substantially towards 2%. What are you doing, market? Not pleased immediately. So what does the Dow do right there? Dow goes down 59, NASDAQ down 243, S&P down 47. So we are taking a little bit of a plungerooski right here on the initial reaction to the Fed. Essentially, they are trying to tame expectations. So market said, hey, we're cutting. Let's see if this thing updates like record fast. It scooted this one back. It scooted this one. It gives you a 7.5% probability now. A pause still happening there in May. Let's see, how's the market doing? Dollar up, gold down, stocks down, up dollar. So definitely attempting to calm the market's expectations in regards to Federal Reserve rate cuts in the federal funds rate. Let's read that once again. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in blah, 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 blah. None of that matters. This is the sentence. That is everything. They haven't included that before. So that's a new one right there. So they're trying to calm the market on thinking about rate cuts. That's okay, right? That's okay. Because on this channel, we know rate cuts are bad. Rate cuts are not something we actually want. Rate cuts have typically been the mark of end of times. So it sounds like they're trying to let everybody think that they're going to continue holding them. Of course, eventually the market tends to force their hand. So even though we all have this expectation of they're going to do it when we expect them to do it, past history has shown something happens in the market and it forces their hand to do some type of emergency cut. So they did pretty much just tell you, hey, if you're thinking we're going to do it soon, we need to see inflation get closer to 2%, which I don't think we're going to see that. I don't think we're going to see 2. I bet it's going to be something that has to force their hand. We've gone through CPI a couple of times. And we've said that, over the next 2 CPI readings, there's a decent chance we actually do see CPI come in at a 2 point whatever, maybe 2.8, 2.9. But then after that could be the bottom of CPI for quite some time, unless there's some type of economic shock that ends up happening. But that's really probably as low as we could probably go on CPI in the near term future is about 2.8 or 2.9%, which is not 2%. So we'll see how that goes. All right, Dow, let's take a look at the stock market. Dow down 64 points, NASDAQ 238, S&P 46. So it's kind of the initial shock, but the market seems to be holding on. You can see an initial fall happening in there in gold back to 239, still holding 244. DXY, kind of like a throwback happening in here, still holding up Nothing, no big breakout has happened in here really, or breakdown has really happened throughout here. So essentially the market got what it was looking for. It was looking for a pause, had a 95.9% probability of a pause. However, you could see the wording in there was just trying to tame the market down and say, hey, look, I know you're wanting these rate cuts. We want to see inflation calm down. Many times, though, the market's going to force their hand at some point. Oh, back. There we go. So market still puts it. Market hasn't changed its stance yet. So we'll see how that goes. Bitcoin now at 43,540. Dow coming back a little bit there. Looks like it's taking a little bit of it back. Again, remember, this is the initial move, right? A lot of times the initial move can be the wrong move, and these things can go back and forth and yo-yo like crazy. The big thing will be when Jerome Powell does come out and speak. So, okay. There we have it. They are paused as expected. Nothing changed there. The thing that is different from their press release that we haven't seen in past ones is that sentence, and considering any adjustments to the target range. Let's go check. Hey, boy, that would be really dumb of me if that's not true. But I do believe that was not in there in the past one. Let's go double check. When was the last one? Somewhere in December, right? It wasn't November, was it? Was it November? There it is, December. So this is that same paragraph. This is the one from December. So if you're listening right now, I'm not reading the current one. I'm reading December's right now. This is when they said, in support of the goals, they're going to maintain the target range of 5.25 to 5.5. The committee will continue to assess additional information and its implications for monetary policy in determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags in which monetary policy affect economic activity and inflation, and economic financial developments. So I guess the wording has kind of shifted from being like, they didn't include this sentence in there. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2%, the committee will take into account cumulative tightening of monetary policy and the lags. Okay, so this has been removed. So maybe it's different. All right, so in the one in December, they actually used the words in determining additional policy firming. That was not included today. Today, nothing about firming in here at all. So it sounds like, like just totally committed to no more firming, or no more rate hikes. But like, when are we going to be cutting? And it doesn't sound like they're ready to commit to anything in regards to cutting. But discussion of additional firming, right? In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy. So they don't even talk about having to do additional policy firming in this one like they did in the last one. They're just talking about, hey, we don't think it's appropriate to cut yet. There's nothing to talk about additional firming like they did in the last one. But we'll see. We'll see what they end up saying when Jerome Powell comes out and talks. So there you go. Initial reaction by the market. Gold slightly pulled back, but still positive on the day. DXY comes back up a little bit. And Bitcoin slightly down from where it was. The Dow Jones has taken a turn downwards. Dow Jones is down 66 points, S&P is down 47, and the NASDAQ is down 237. Crypto in general, unaffected. I would say unaffected by the initial response. So the cryptocurrency market doesn't seem to have any real kind of impact happening in there. So that's good. That's good. Nothing happening there. Just kind of a little bit of a washing machine. And again, this can be interesting because a lot of times the first initial reaction that you see in the market is not the real reaction. We almost are kind of like potentially wasting our time looking at all of it because a lot of times it does flip around in the middle of Jerome talking. Sometimes one particular question is the thing that gets things set off and moving. So, all right, there we go. So now that we have about 20 minutes until Jerome Powell is going to come on, we kind of got to soak in the wildness there for a minute. Rates stay paused. Additional firming language has been removed from the FOMC statements. However, they have said they're not ready to start doing cuts, and they want to see proof of inflation going to 2% before considering doing it. But the language of additional policy firming has been completely removed from the FOMC statement, as we did have back in December. So there you have it. All right, let's hop into the chat. We're just gonna try to burn time. We're pretty much burning 20 minutes. And so just so you know, when we do get down there to the final minutes of what happens, I do enlarge Mr. Powell. He is the superstar of the Blockchain Backer YouTube channel for about 30 to 45 minutes. I will turn off my mic. I will sit back quietly and just watch like the rest of you guys and probably hang out in the chat. Maybe take a nap. I don't know. No, I'm just kidding. But I do sit here quietly, and I don't say anything during this, and we just sit here and watch the market reaction during that time while Powell does speak, and that will be in about 20 minutes from right now. So if you need to use the restroom, if you need to go get a snack or a beverage, or find some, you need to bail out of work because screw that and go hang out at home, you got about 20 minutes to get home. Okay, hanging out in the chat here for 20 minutes until Powell comes on. Norwegian Ape gifted a BCB membership before we even got going. It was about an hour and a half ago. Mark Duval gifted out 5 to people just hanging out in the chat. Thank you, Mark. I appreciate it, guys. And these, of course, were guys just hanging out in the chat before we ever went live. Fun story. I exercised right before I went live, and I got back in front of the computer about 5 minutes before. So anybody who was sitting here for about 20 minutes, I was over there sweating my tail off. But now I'm just sitting here like this hot, sweaty mess, live streaming. Miles Pry, member for 4 months. Will Powell remind everyone what day it is at the end of the meeting? I was looking forward to this stream for a week, BCB. Everyone liked the stream. Can you believe it? The clock starts over. The clock starts over. Thank you, Miles, member for 4 months. Gator gifted 5 BCB memberships. Gator, thank you very much, man. And anybody who gets one, if you're in the chat and your name flipped green, that's the community hooking up. Thank you, Gator. Lasse Hansen gifted a membership as well. Thank you. Matt Smith, I love seeing the XRP FUD. Wasn't here in 2017, but it's exactly as you said it would be. Dear baby Jesus, send this thing. Thank you, brother. It is the most bizarre thing in the world with today's events. And where they're happening, right? The things that we've been watching for so long, and then just the magical unicorn fairy dust happens right there, doesn't it? That's crazy. If that marks it, you all witnessed it again live. And the tinfoil hat and the magical unicorn fairy dust, Puppet Master's pulling the puppet strings. God or a simulation takes the win again. George Alexander Ropoulos, member for 7 months. Smash the likes. I sent you a DM on X with the zoom in look on Bitcoin all-time high distribution versus now. It's very comparable structures. Thanks, George. I'll check that out later today. Arday says, any update on BCB Teachable? Yeah, I always update it for the old one. I had a market update there every last day of the month. Yep, it'll be up there today. Just busy. Last day of the month is always ridiculously busy for me with how much work I do. And then the Fed decided to do their meeting on the same day. Thanks. Thanks a lot. Yeah, it'll be out there. So, all right. All right, so there we go, guys. That's it. That's what you got going on here. You got just kind of an initial reaction of down. And that's interesting because a lot of times the first reaction is not the real reaction. And that's the one we got initially right out the gates on this. So Bitcoin 43,335, Dow 38,418. Not a huge change over here in the crypto market. Can you believe it? Everybody XRP is green for the day. The stock market indexes: Dow down 57, Nasdaq down 230, S&P down 46. Does anybody have a big hit? Nobody took a huge hit. Nobody like broke themselves on any of that. Google was already having a bad day for the day. Nvidia was even worse than this this morning. So it's not a big change in there. No change really in yields. This is what yields looked like earlier today. So I don't see anything big changing in there. Silver was having a better morning. Gold was having a better morning, as you can see right in here. But so this is kind of a pullback, and DXY moving back as well. But we'll see how things go once Jerome actually does start talking, because a lot of this could just be complete and utter nonsense until he gets his mouth yapping. And once I stop yapping mine. There we go. Eric. No, I skipped one. Sorry. Kashav says, hey, BCB, on the 17th of December, on December 7th, 2017, Ripple announced partnership with Amex, and that was the spark of the bottom. I mean, that's just luck. It was just pure luck. I mean, I was here during all of that. I was here when XRP took off. There's a million Ripple announcements at all times. They never impact price. It's got to be market conditions to corroborate it, right? You have to have Bitcoin up. You have to have stocks up. You have to have all these elements already up. It's not Ripple. You know, I guarantee you that the flip the switch narrative is going to be perpetuated like ridiculous. But you just have to have the market elements already there. And all those market elements were there at that time. And we have a lot of positive elements right now. Just need a flip switched or switch flipped. Eric talking backwards. Let's see how well I can read backwards. Says magical unicorn fairy dust puppet masters pulling the puppet strings. God or a simulation like this video. I don't know if I could have read that quick had I not already known exactly what it was. How's it taste society? He says, I have a 401k through my employer. I just changed it from a stock fund to a fund that's 90% bonds. Dang. Crazy. There's somebody who went for it. Taking the shot. And so there you go. There's NDXT for those who have followed all this stuff. We got really still exactly as anticipated happening over here. We'll see how long this thing kind of just chills out in here and just how everything reacts today after the Fed. Looks like still a little bit more of a continuation down happening here in Bitcoin. Now that the dust is starting to settle a little bit. Gold's down a little bit. DXY still, I wouldn't call these big moves over in here. Dow Jones is still a little bit down. What's it down? Dow's down 56, 47 for S&P, 237. Just not big moves happening right now. Things like there was initial reaction. Now the entire market's just waiting for Powell. Oscar Hernandez says, hit the like. Let's go. 3,278 people in here. We got 860 likes. The number one way to support the channel is liking the video. It's the only way. Okay, so now we're just kind of burning time. Trying to go through the chat and see if there's any worthwhile questions. Extra P Dummy says, happy B-Day, BCB fam. Sorry I missed you this morning. Yeah, Solidify says, I found out about you through multiple friends. I think YouTube might be low-key shadow banning you in a way, maybe. It's been like that for a long time. It's whatever. You can kind of see by how well YouTube actually gives you the stats of how much they recommend your videos and how much they push it out to broader audiences. It's been like that for a long time. It is what it is. Learn to survive like that. Tyler says, I agree with your retrace theory, but what targets would your thesis be invalidated for Bitcoin to reach all-time highs? Dow Jones Industrial Average breaking a 4.236, Bitcoin breaking a 702, or a combination of those? Yeah, we talked about that kind of markets in the morning, right? So the big thing with the stock market, obviously the NASDAQ and the Dow Jones are both very close to their 4.236 extensions at the same time. There were markers that became present at the peak of like the great financial crisis and at the peak of COVID before things started crashing and crumbling. First elements are rate cuts, right? Rate cuts are bad. It's totally the most misguided culture in crypto that the start of rate cuts is they're going to start the money printing meme with Jerome Powell. It's like this. It's just so ridiculous. It's not true. The start of rate cuts are utterly horrible for markets. Like, yeah, sometimes you get like a month or 2 or 3 of the market like sustaining itself after rate cuts happen. But the only reason rate cuts are happening is because something is breaking economically. There are problems that are happening. Liquidations are on the horizon. The beginning of rate cuts are not good. It's when we're at like a 0 interest rate environment and the Fed is just plowing money and Congress is shooting money out of every side into stimulus stuff. And like, that's a different story. The beginning of rate cuts is not historically good. So if you start seeing like the beginning of rate cuts start to happen, you see the markets pull back, we see gold break out in a new all-time high, you got big problems, man. Gold breaking out into a new all-time high was like the classic signature of the peak prior to the great financial crisis and prior to the COVID collapses, both of them. So that's the thing to really watch for. Like so like just because like Bitcoin hits 702 or it hits 705, 738, right? It goes just a little bit above. We would have to see multiple things happening in that. Like the Fed's not going to be cutting, economic conditions are okay. This thing is just like plowing through the 4.236 extension, and really you'd want to see evidence from this guy because this guy typically tells the story. Gold. If gold started crashing and crumbling, that's a pretty good sign. So we'd look for. I'd be looking for a lot of different elements. Anybody cheering for Bitcoin to break through the retracements right now, you're cheering just for something totally different. Even in your best case scenario throughout all of history, you have to pull back to 30 to 32. Other than last year, saying this time is different, which everybody always says this time is different, and that's fine. I can't base anything on this time is different. It's not how I operate. Otherwise, you're not using anything. You're not using anything for anything. But it is different. There's ETFs. Okay. All right, I'm going to stop right there. I just earned a lot of thumbs down. I'm certain of it. YouTube has said, we're not going to share your videos around because you're not following the narrative. Please like my video. I'm very lonely. All right. Yeah, no, I just, I don't think it. You also have everybody wrong. Like all of the people are long Bitcoin right now, right? Retail was very underweight Bitcoin. Then at the peak, they're all overweight. Right now, it's the same story. They're all in it. Who are you going to lure in now? Who isn't already in? Everybody's in. All the 12Kers are in. They're all back. They're not sidelined anymore. They're all in. Once that group came back in, that's it. Spags says, what are your thoughts on Ripple working with Hedera? I don't know, dude. Partnerships tend to mean nothing. And like we could so loosely call things partnerships, can't we? That's the hard part. That's the thing where like we really overstate the word partnership in crypto. All right, we are 6 minutes away. Thank you, Spags. I love you, dude. I know you love Hedera every day. I know it's your thing. Jimmy Calderon. Saludos, blockchain backer. UPS driver here, listening to you while delivering. Yeah, dude. All right, you probably caught what we were talking about yesterday. Then I saw Zero Hedge retweeted the same thing that I was talking about with the 2 girls. Like, oh, I think he works for UPS. Goosebumps. Okay. Yeah. This is kind of how markets in the morning goes. It turns into kind of a goofball show for the last 30 minutes. We typically get all the information out in the beginning and then just kind of goof off for a while. But we are 5 minutes away from Powell, so we'll start kind of like getting serious, because once we do get to that, I do shush. I don't know what's going to happen with the market during that. We're going to all just kind of watch it together and see how it goes. Jasper says, why do you often joke end of the world at Great Depression? I'm not sure what you mean. Why do I joke? I don't know what you want me to do. What do you want me to come on here and be like, it'll be okay. You'll be fine. That's what my wife always tells me. I'm like, I don't really feel good. She's like, you'll be fine. Like, I hurt my leg. You'll be fine. I have a fever. You'll be fine. I have a cough. You'll be fine. Take an allergy pill. Meanwhile, she when she gets sick, it's like, oh. Okay, enough. And people watching the replay of this. All the people who are watching the replay, they're like skipping to this point right now, and I don't want them to hear this part. I just want them to be like, oh, this is a very professional live stream. Okay. All right, so there you go. Gold still down. DXY up. Bitcoin down to 43,200. Dow Jones down to 38,400. 55 down 55 for Dow, down 47 for S&P, down 240 for Nasdaq. Anything else to focus on before we get ready to just kind of sit back and watch what Jerome Powell says? Again, let's just read through this really fast. Again, just so we are aware, this is December 13th. Here we go. This is January 31st. Again, they kept the federal funds rate at 5.25% to 5.5%. And considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. Sounds like strong language. Sounds like them saying, we're not cutting. But it's important to reflect back on what the last one was. It says, in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of policy, the lags, blah, blah, blah. But they use this language in determining the extent of additional policy firming that was removed from this statement. Now it's saying, hey, this is like a saying we're paused. We are officially paused, which they didn't say it in their statement last time. They're pretty much saying it in this time. Now it's about when are they going to cut, and they're what data it is. So people are probably going to ask them, what data are you looking for to tell you that you're done and that we're going to be cutting and blah, blah, blah. So that's what we're waiting on. Jerome Powell will be going live soon. I know everybody loves to do this thing. We're going to shift over here so it's not blocking Mr. Powell and his hard swallowing. Over-under is 11.5. Pick your poison. Should I do a poll? Really fast. Over-under. Start poll. It's only running for... No, I'm not going to do it. We'll be a little bit more mature today. I think there's professionals who are watching this. Okay. I have to turn the volume off here on my desktop audio because I am going to play this. Okay. Very good. Very good. Okay. All right. Powell will be live in 1 minute. Jaxer says, I'm in class and I could really go for a frog right now. Right, so the frog only will get played unless there's got to be something crazy positive that happens in the market. I don't know how the market's going to react during this. We're just going to watch it together. Okay. You will see me bouncing around a little bit in the middle of this. These are pretty much the primaries that we'll be looking at: gold, DXY, Bitcoin, and Dow Jones. And you will still be able to see the assets on the right side of the screen over here and over here. Okay. All right, guys. I'm going to go ahead and turn my mic off. Sit back, enjoy the show. You can't play that music, Federal Reserve. We're going to get in trouble. YouTube's going to be mad at that. We got to wait. Okay, it does look like they have turned the music off now. So I am going to go ahead and go quiet. See you on the other side.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Gina Smilek from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to, a sustainable path down to 2% inflation.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2% so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or experience. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all because, for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see, the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above, core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline. And the case is likely that it will continue to come down. So that's where it is. But we're wanting to see, more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming. and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. You know, the supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, you know, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but you know, we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that, you know, that other set of factors is really different from other cycles and has brought that, working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's, of course, you know that it's not something you can identify with any precision. But a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you know, you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, you know, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Rich.
Thank you, sorry. Thanks for taking the questions, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market, I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote-unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think, you know, job openings are not quite back to where they were. Wage increases, rather, are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens, it's you know, probably will take a couple of years to get all the way back. And that's okay. That's okay. But we do see, you saw today's ECI reading, you know, the evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and you know, I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, you know, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And you know, one great way to look at that, and you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to where what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could re-accelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would re-accelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not, rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months. But what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%, and there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy, and the question will be, what is it that has changed? The productivity tends to be based on fundamental aspects of our economy. Is there a case? Will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity
That's
right
one
now?
way to look at it, yeah.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate, or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle-class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down, and the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them, but we're at the beginning of that process, I would say.
Quick follow-up, is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet run off to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up in the committee. We'll get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that is where, that inflation is on a sustainable path down to 2% or toward 2%.
Daniel. Hi, Chair Powell. Daniel Davis, Agence France-Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case, and we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Menace, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at individual companies, individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that, and so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the Outlook go around, they'll say in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks, and I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them note a slowing economy based on what they've heard from their district?
Yes, I mean if you look back at the last, not this beige book, but the one before, it was more. There was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Let's go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now and that inflation could come back at some point?
I'm not so worried about that. It's, again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
There we go. That is it. Market took a tumble. I don't know if you guys caught the exact moment it happened, but I sure did. It happened the exact moment that he said, we're probably not going to have a rate cut in March. And so the market has been pricing like a 50% probability, greater than 50% probability today that there would be a cut in March. He essentially said no. I felt like he was really dodging everything. Let's take a look here. Probability. See if it's this. There we go. Now it has shifted more towards 64% probability that they will be paused there at the March rate hike. So 2/3 probability that they will be paused. That is the exact moment that this market took a little bit of tumble risky. Not too much though. I mean, you can see we're still just really at where we were at earlier today. For Bitcoin, Bitcoin's only down $51, which is 0.11%. But the stock market really took quite a little bit of a tumble there. Dow is now down 215 points. So it actually had bounced back at one point up about 80 points and then whoosh, went right back down to the downside the second he said, it's not in their base case that rate cuts will be happening in March. So there you have it. That's our wrap up for today. That's the wrap up for the Fed meeting today. I'm going to hop into the chat. I'm going to speed fly through the super chats in there. And I saw you guys just going on a gifting rampage of memberships in there, and I'll address all of those. But as for like long-winded questions, guys, we're just going to get through everything really quick in here. Flying Sean says, you've always mentioned rate cuts have been bad for the last 20-ish years. Was that true before 2000? We'll have to take a look at it. This is the QE era, right? This is where the Fed has done a lot of interjecting ever since the great financial crisis. This is all great financial crisis recency, right? Romano wanted the frog. We don't get the frog today. We are punished. The market has punished our ability to have frog today. Looks like Bitcoin has gone back green now that Jerome has shush. No more talking for Jerome. Markets are flipping back to the other side. So there you go. DJ Friendly, if XRP doesn't take off and Bitcoin is finished distribution phase, will you tell us if you sell your XRP, I'll exit with you? You're going to have to decide that on your own, brother. Following a YouTuber and exiting when they're doing their moves. With XRP, this has been a zero or hero play. Kashab Lakshman, would you consider leaving the U.S. when S hits the fan? No, America's the greatest country in the world. Holy Shnikes, odds of 32,000, then 53,000. I don't know what the odds are. Jaxer, member for 8 months. I'm in class, but thank you very much for the super chat. Holy Shnikes. Jaxer says, I'm in class, but I could really go for a frog right now. No frogs. Eric, I'm just going to read these off because you guys were wild during the middle of the stream. Eric had gifted a BCB membership along with Eric Raymer, then Eric again, and then Eric again. And then Follow the Fiat had said, Jerome looks anxious. Jerome always looks funny during those pressers. That's nothing new. That's always kind of happened like that. He clearly is very uncomfortable in those situations. I think he knows he has the power to move markets with the words that come out of his mouth. If I could say anything, I bet he really regrets the fact that he said, I don't think March is our base case. That was probably a slip up on his part. You could tell he was really avoiding everything. And then when he answered that one, boom, it moved the market. And so I think he is watching every word, and he's gotten good at it over the years. He watches every word that comes out of his mouth. I bet that was a slip up on his part to say that. Eric had gifted, man, Eric again, Eric Raymer, Eric, and Code 9 Geez, you guys, thank you. Sam DeLuca had gifted one as well. Then Eric again, guys. Gibbs was joined on his own. Gibbs, thank you. Code 9 gifted one. Eric Martinson, Brandon Hammond, Eric Martinson, Code 9 gifted 5. Eric Martinson, Eric Raymer, Eric Martinson. KB gifted 5. Eric Martinson. You guys were very generous in there. If you got your name flipped green there in the chat, guys, that was the guys helping it out. Crypto G-Man, member for 4 months, has been following since February 2021 from Great Britain. Big up BCB. Thank you so much. Eric gifted another one. So did Sam DeLuca. Tyler Bonar joined on his Bonner. Check the tape. Code 9 gifted a BCB membership, followed by Eric Martinson, then Eric Reimer. Julian Robbins, member for 3 months, says, we get through it one day at a time. Good day, gentlemen. Thank you, BCB, for all that you do. That's right. Eric Martinson gifted one. Russell Alvarado, does the XRP versus Bitcoin price chart look like wave accumulation? Let's do that another time. We don't spend a lot of time on the actual altcoin pairings versus Bitcoin. Jaxer says, if we flip green tonight, can we frog tomorrow? Yeah, like I said, if XRP fires up or something, it goes 59 cents. I'll play the frog on a Thursday. CryptTKO, isn't it a good thing that will be paused in March? Yeah, it's a good thing. Oscar says, BCB, I'm telling BTW, I got it on tape. There we go. Yeah. So then we could talk about that tomorrow in Markets in the Morning. We're going to kind of wrap this thing up really quickly. There's a long history of the Fed rate cuts. The second the rate cuts start, we know we're on the ticking clock, right? It's just blatantly obvious, it's just clear as day. If the rate cuts start, the clock is ticking. So, all right, there we go, guys. I feel like there was something else. Take a look over there. Gold down, DXY up. And stock market took a big tumble there. Dow Jones Industrial Average down 233, S&P down 63, NASDAQ down 281, NDXT, right, still kind of just following along to true expectations in here. But there you go. We'll see if Bitcoin can find some support, and if the rest of the market finds some support, and then we'll check in on it again tomorrow. Still 30 minutes left of the stock market trading right now, so probably still some more volatility before the day comes to a conclusion. Otherwise, guys, I'm going to go ahead and start wrapping it up. Again, I put out a newsletter today. Check it out over there on blockchainbacker.substack.com. There's a link right there in the chat right now. There's a link in the description of this live stream. Otherwise, I will catch you all tomorrow. That's going to be it for this one. Thank you so much for watching. If you could, please like this live stream and give it a thumbs up. If you are new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice and I am not a financial advisor, but if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.